In today's world, there's no excuse to back out of investing. There are plenty of investment options, even for beginners. And investing in the stock market is a great way to grow wealth. And whose name comes to mind when you hear the stock market? Yes, Warren Buffett. Warren Buffett is known today as the world's smartest investor. If you had put just $1,000 into his company, it would be worth over $17 million today. But what advice does the smartest investor in the world have for beginners? Stick around to find out. Hey go-getters, welcome back to another profitable episode of The Early Investors, where you can learn how to become financially free. In today's video, we'll be giving you Warren Buffett's investing principles and some advice for beginners. Want to become the next Warren Buffett? Stay with me to find out all the tips and tricks to save your hard-earned simoleons. Before we jump into the video, make sure to subscribe to our channel for more business-related content. Warren Buffett defines investing as the process of laying out money now to receive more money in the future. Even investing a small amount can reap big rewards. Of course, you need to have at least a small amount to even consider investing. If you don't have the funds for investing, then you should consider saving money. You can start investing once you have a little money to play with. Warren Buffett's first principle of investing is that managers must have integrity and talent. According to Warren Buffett, we look for three things when we hire people. We look for intelligence, energy or initiative, and we look for integrity. And if they don't have the latter, they might as well be dumb and lazy. The second principle is to invest by facts and not emotions. The stock market is greatly influenced by emotions. Investors tend to behave in very human ways. They get very excited when they make money during bull markets and say, "I made money last year, so I'll make more money this year. So this time, I'll borrow." So they always look in the rearview mirror. When they look in the rearview mirror and see a lot of money having been made in the last few years, they plow in and push on prices. And when they look in the rearview mirror and see no money having been made, they just think it's a lousy place to be. They don't care what's going on in the underlying business, and that makes for a huge opportunity. The next principle is to buy wonderful businesses and not cigar butts. What are cigar butts? I'll explain. Warren Buffett was taught by Ben Graham that he should buy things on a quantitative basis. So he used to take what he calls the used cigar butt approach to stock trading. When you walk down the street and you find an ugly, soggy cigar butt, one puff left in it. You take that one puff, it's gross, so you throw it away, but it's free. It's cheap. For many years, Warren Buffett made this approach to buy stocks. He said it was a mistake. Although you make money doing it, it's not big money. So buy wonderful businesses for a fair price, not fair businesses for a wonderful price. The fourth principle of Warren Buffett is to only buy stocks that you understand. Warren Buffett has an old-fashioned belief that he can only expect to make money from businesses that he understands. And when he says understand, he doesn't mean to understand what the product does or anything like that, but to understand the economics of the business and what they're likely to look like in 10 years or 20 years from now. Warren Buffett took Wrigley's chewing gum as an example. He said that he understands the chewing gum market as it is unlikely to change. So even if he can't pinpoint the numbers 10 years from now, he's not going to be way off. Evaluating that company is within what he calls his circle of competence. He understands what they do, the economic aspects, and the competitive aspects of the business. So only buy stocks in businesses that you understand. Warren Buffett's principle number 5 is, when you see a great opportunity, take it. One of the biggest mistakes that Warren Buffett has made is the mistakes of omission and not commission. It's things that he knew enough to do, they were within his circle of competence, and still, he didn't do it. It hurts, but it does not show up in conventional accounting. Buffett says that he cost Berkshire at least $5 billion when Fannie Mae was having some trouble. You don't have to worry about if it's not within your circle of competence, but still, big opportunities in life have to be seized. We don't get to do many things, but when we get the chance to do something right and big, we've got to do it. Even doing it on a small scale is just as big a mistake as not doing it at all. Warren Buffett's sixth principle is not to sell unless the business fundamentally changes. In terms of our wholly owned businesses, we're not going to sell them no matter how much anybody offers. We can use that approach in stocks too. Now, if we were chronically short of funds and all kinds of opportunities, then we might have a somewhat different approach. Our inclination is not to sell things unless we get really discouraged with the management, or we think that the economic characteristics of the business change in a big way. I mean, it can happen sometimes, but we're not going to sell simply because it looks too high. Warren Buffett's last and final principle of investing is to buy at a price below intrinsic value. So, what is intrinsic value? Well, according to Warren Buffett, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that the business would give you between now and Judgment Day, discounted at the proper discount rate. That number is what the intrinsic value of a business is. The only reason for making investment and laying out money now is to get more money later on, right? Suppose you're going to buy the Coca-Cola company. The question is, would you lay out the money today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? That is a question of how much cash they're going to give you. It's true for any financial asset, whether you're buying a farm or a house or an apartment. And the question is, how much you're going to get, when you're going to get it, and how sure you are. When Warren Buffett calculates intrinsic value when he buys businesses, whether all of a business or a piece of a business, he always thinks that he's buying all of the business because that's his approach to it. So he looks at it and says what will come out of the business and when. So the question is, if you're going to buy a company, can the cash be distributed soon enough to make it sensible at present interest rates to lay the cash out now? And if you can't answer that question, then you can't buy the stock. You can always gamble in the stock market, but if you want to make a smart investment, then you have to answer this question before deciding to buy a stock. You can't answer this question for some companies or types of companies. Like, for example, Warren Buffett can't answer this question for tech companies like Microsoft, and he just stays away from those. So always buy at a price below intrinsic value. It's fascinating that these 7 simple principles of Warren Buffett that he stuck to over the long term gave him such a huge return on his investments. But there are so few investors capable of being rational, sticking to these guidelines, and not giving in to our emotions. That's the hard thing most of us fail to do. Few will be able to do so, and those few will make the big bucks. With that, we've reached the end of today's video. I hope you enjoyed it and found it useful. If you did, make sure to smash that like button. Also, subscribe to our channel and ring the notification bell so you don't miss out on our latest videos. Thanks for watching. I'll see you in the next video.